Okay, so you've got an accounting test breathing down your neck. I totally get that feeling. But hey, don't sweat it. We're about to break down the one core concept you have to know to pass. And I promise, we're going to make it so simple you'll feel way more confident walking into that exam.
So, let me ask you this. If you could only cram one single thing into your brain before the test, what would it be? Well, that's the thing we're going to master right now. So, here's the game plan. First, we're going to cover the 5 key elements, the basic building blocks. Then we'll put them together into that core accounting equation. After that, we'll see how real-life transactions actually change things. And to wrap it all up, we're going to crush a practice problem that looks just like something you'd see on your test. Sound good? Let's get into it. Right, before we can even touch the main equation, we've got to know its parts, right? You can't build something without knowing what the pieces are. So think of these 5 elements as the basic ingredients in our recipe. And here they are. You've got assets, liabilities, equity, which you'll sometimes see called capital, by the way, then revenue and expenses. And hey, here's a little test day tip. To remember them, just think of the word ALER. A-L-E-R-E. Super easy. So let's just quickly run through what each of these actually means. Okay, first up, assets. The easiest way to think about assets is this. It's all the stuff the business owns that has value. Simple as that. That could be cold hard cash in the bank, inventory on the shelves, or even big ticket items like land and buildings. If the company owns it, it's an asset. All right, next are liabilities. And this is just the flip side of the coin. If assets are what you own, liabilities are what you owe. Think of it as the company's debts. We're talking bank loans, mortgages, basically any money the business has to pay back to someone else. Then we've got equity, which, remember, is also called capital. This is the owner's slice of the pie. It's their personal stake in the business. Basically, it's the money the owner themselves has put into the company. Revenue. This is the fun part. This is the money flowing in. It's what a business earns just by, doing business. So when they sell a widget or perform a service, that cash coming in, that's revenue. And last but not least, expenses. You know the saying, you got to spend money to make money? Well, that's what expenses are. It's all the costs of keeping the doors open. Things like paying salaries, rents, and keeping the lights on. You need expenses to generate that revenue. Okay, so now you know the 5 core ingredients. Let's take the first 3, assets, liabilities, and equity, and build the single most important formula in all of accounting. I'm not kidding, this is the golden rule you need for your test. There it is. Assets equals equity plus liabilities. Seriously, tattoo this formula on the inside of your eyelids. It is the bedrock of everything in accounting. Every single thing a business does, every transaction, has to keep this equation perfectly balanced. No exceptions. And this isn't just some random math formula, It's the entire foundation of what's called double entry bookkeeping. It tells a very simple story. Everything a company owns, that's its assets, had to be funded by someone. It either came from the owner's pocket, that's equity, or it came from someone else's pocket, like a bank, and that's a liability. It has to balance, always. Okay, theory is great, but let's see how this thing actually works in the real world. Let's look at what happens when a business, actually does something. Okay, picture this. You're starting a new company. First thing that happens, the owner has to put in some cash to get things started, right? So let's say they invest $100,000 in cash. What does that do to our equation? Check it out. The business now has $100,000 more in cash. Cash is an asset, so the asset side goes up. And where did that money come from? The owner. So the owner's equity also goes up by the exact same amount. You got $100,000 on the left side, $100,000 on the right. See? Perfectly balanced. All right, example 2. The business is growing, it needs more cash. So it goes to the bank and takes out a loan for another $100,000. Now what happens? Okay, again, the business's cash account goes up by $100K. So the asset side of our equation increases. But this time, the money didn't come from the owner. It came from the bank. That's a loan, which is a liability. So the liabilities part of the equation also goes up by $100K. And boom, just like that, it balances again. See how that works? Okay, you've seen the theory, you've seen a couple of simple examples. Now it's time for the main event. Let's put it all together and work through a practice problem. The kind of thing you're definitely going to see on your test. This is going to be a huge confidence booster. All right, here's a setup. We've got a business called Cups and Saucers. We've got our starting numbers for assets, liabilities, and equity. And notice, they already balance. Our mission, should we choose to accept it, is to go through these 5 transactions one by one and see how they shake up the equation.
Okay, let's break this table down line by line. Don't worry, we'll take it slow. Transaction 1. The owner puts a $10,000 vehicle into the business. A vehicle is an asset, so our assets go up by $10K. Since the owner provided it, their equity also goes up by $10K. Check, check, we're balanced. Next, that bank loan. We get $30,000 in cash. That's an asset, so assets are up. But now we owe the bank, so our liabilities also go up by $30,000. Still balanced. Third, we purchase 20 grand worth of goods on credit. Those goods are inventory, another asset, so our assets are up. But on credit means we haven't paid yet. We owe that money, so our liabilities also jump up by 20 grand. Number 4, we sell $15,000 worth of goods, also on credit. That sale is profit that belongs to the owner, so equity goes up by $15K. But wait, the customer hasn't paid us yet. That money they owe us is an asset called accounts receivable, so our assets also go up by $15K. Still balanced, see? And finally, the owner takes out $500 for personal use. That means cash, our asset, goes down by $500. And since the owner took it, their equity also goes down by $500. So let's do the final math. Add it all up. We have $174,500 in assets. And on the other side, $80,000 in liabilities plus $94,500 in equity, which equals $174,500. It balances perfectly. And this quote right here just sums it all up perfectly. This isn't a guideline or a nice idea. It's an ironclad rule. If your numbers don't balance, you know you've made a mistake somewhere. It's the ultimate safety net when you're doing your test problems. So, as you're studying for this test, try to think bigger than just the numbers. Don't just see it as a formula to memorize. Every single transaction, it's a little event in the story of a business. The real question is, what is that bigger story the accounting equation is telling us? How does a company get its money, and what does it do with it? Think about that. Hey, good luck on your test. You're going to do great.